I want to bring in our first guest. Scott Ladner is joining. He's the Chief Investment Officer at Horizon Investments, back with us. Scott, I want to talk on the macro front first, as JB and I were just discussing. I'm curious from your thoughts on the bond market. What needs to happen to continue to have a little bit of relief on bonds, let yields climb up? Do we need incrementally better information on trade? Or if we get decent data from around the world, is that going to be enough to keep bonds selling?
Hey, thanks, Ollie. The bond story right now, we think it's probably going to be centered mostly around the trade issues and mostly around which you can't decouple from the global growth concerns. Now, the one thing, probably the most interesting thing about bonds right now isn't necessarily what's going on in the trade or what's going on in global growth or anything like that. It's really having to do with positioning. Right now, you can look at something. It's a little bit of a technical term, but you can look at skew inside the Treasuries futures options market or inside the swaption market. And skew in a fixed income world isn't really like the equity world in that the skew is always to the put side in stocks, but bonds is really more of a supply demand sort of dynamic with rates. And so right now, the thing that we're looking at is there's a lot of positioning for rates to go lower from here, which means the pain trade is for rates to actually head higher. It's consistent with the pain trade with equities as well, but that's probably the most interesting thing that we're looking at right now in terms of the rate market.
This is, I think, is really important, Scott, because if we look at, again, the chart of TLT on the year, the 10-year future, even with the incrementally bad information that we got on the ISMs a couple weeks ago, bonds didn't make a new high on the year. To your point about positioning, maybe the market got too one-sided in August and September. Then we have the sell-off, not just on trade, but we also had a little bit of sell-off on the jobless number. What I'm curious about is if the logic for the low yields was not the U.S. economy for the past year and a half, and it was the global hunt for yield that we heard so much about, then is it possible that if we do still have some softness here in the U.S., that any sign of improvement in the global economy could continue to put pressure on bonds?
We think that's definitely the case. So probably more the case in places like Germany and largely Europe than in the United States. Because you're right, there was and there still is a great rush for U.S. Treasuries because just look, they're the best yielding sovereign debt out there. And by the way, the currency's been appreciating as well. So if you've been a foreign investor investing in U.S. Treasuries, you won not only from price appreciation, but you've also won on the FX side. So there's kind of a momentum aspect towards the rate move in the U.S., at least from a foreign perspective. But you could see some pretty material moves higher in boon rates, which are basically tied one for one with U.S. rates currently. And that kind of move would just catch people off sides, and offsides positioning can lead to some pretty violent short-term moves.
So we know that the market obviously highly responsive to anything on the trade front. I think last week too, what was really important that maybe even got a little overshadowed was the Brexit situation, where there were murmurs and rumors that maybe there is a possibility of a less than extremely hard Brexit. Is there also kind of risk factor built into some of the other geopolitical events outside trade? I mean, I know it's everything that we talk about here, seemingly a tweet-driven market. But should we be watching for any surprise on that front?
Should we be watching for a surprise on the Brexit front? Yeah, I think that's all you get. I'm not sure you get anything that approaches like a normal course of business or a normal negotiating stance. This is the world that we live in right now, both on the U.S.-China side and also on the Brexit side. It's not necessarily a bad thing. It is the nature of how people are negotiating, much more so in public now than they did 10 or 15 or 20 years ago. Negotiating happens a lot more in public now, which means that markets have a lot more to chew on, for better or for worse. But it's, in terms of finding surprises, like we would expect to see all sorts of headlines and all sorts of trial balloons floated on both sides, both the EU side and the British side, about what could possibly happen on the Brexit negotiations. We are coming up on that Halloween deadline.
So let's talk here about where you guys now want to be positioned. Talk about the asset allocation fund for me a little bit, Scott, because I'm curious, after the comment about bond positioning, how does one think about the sort of best way to hedge out risks across asset classes? If there is, pain to the upside in bonds, then how does one think about that in relation to a stock portfolio at a time when a lot of people I talk to, Scott, are very much tied to bonds, even in their stock funds, utilities, REITs, even high valuation software, I think we've seen has proven to be pretty responsive to higher rates when we do get those bond sell-offs.
Yeah, absolutely true. And that is really the key for positioning right now in terms of how we're trying to allocate our assets in that fund and in some of our other funds. We're a little bit different because we're a goals-based investment manager, and so we have a little bit different view of the world. in terms of how we need to manage money for our clients. But that being said, it's difficult to get on board fully with a cyclical and with a cyclical rebound, international-led kind of rally, which we think would be by far definitely the pain trade for this market, which would also have kind of a higher rate component to it. But it's one where you can take money off the table with respect to kind of having exposure to momentum, having exposure to more of the low vol kind of securities. And those types of securities that are generally defensive, people have really piled into, and it's generally been the right thing to do. And it's a hard thing to bet against in the short term, but we've been taking money away from those and just becoming a little bit more neutral with the idea, like looking forward, we have some signposts of some things that we want to see happen in order to jump on the cyclical bandwagon, in order to jump on the international-led equity rally bandwagon. But we need to see some weakness out of the dollar first. And there are a few other things that we're looking for in order to confirm those types of moves before we can really get fully on board with getting on that train.
Really
I think
glad
it's the right train to be.
Yeah, no, I'm really glad you bring this up, Scott, because we've talked about this too. It seems like the dollar will really be that signal if there's a true regime shift, because it's been such a consistent, trend throughout these last 18 months. The last time that we looked at this, the dollar basically every time it looks like it breaks, it doesn't, essentially. So what then needs to come to fruition? Do we need to see some better data overnight tomorrow from the Eurozone and England? Do we need to see progress? Did last week show us that progress on the trade front is negative dollar? What are we learning here over the past couple of weeks about the dollar?
I think you're actually highlighting a lot of them, Ali. We are going to need to see some better. So basically, we need to get some uncertainty lifted from this market. If you get some uncertainty lifted from this market, then there are going to be better places to be than long-dated U.S. Treasuries. And if there are going to be better places to be than long-dated U.S. Treasuries, that's when you're going to see that kind of rotational action. And you might not see massive moves at the index level or massive moves kind of the top line or macro level, but inside these markets, you're going to start seeing some pretty big moves. And that's going to be our leading indicator sign that this shift is really on.
Yeah. All right, Scott, really good stuff. Always a pleasure to catch up. Thanks for the insight. Scott Ladner joining us from Horizon Investments.